Okay, welcome to everybody. Welcome to this first webinar organized by the International Business and Tax Center at the European University in Rome. This is indeed the first workshop organized by the IBTC, the International Business Tax Center, and the topic that we have chosen as a first topic is indeed the transfer price in the era of COVID-19. Let me first briefly say something about the International Business Tax Center, and then we go into the topic and into the content. About the IBTC has been recently launched with an eminent scientific committee where we have prominent personalities from academies and from multinationals. The approach of the center is, this new research center, is indeed to put together the scientific approach with the pragmatic approach. Indeed, in the panel of today, we have many personalities from academies already and from multinationals. We will be starting today from a case study proposed and presented by Giacomo Soldani, and then we go into the details first through the scientific approach with Professor Raffaele Petruzzi, Professor Jörg Brauner, and Professor Andrea Ballancini. And then we go into the the discussion with the multinationals, with Massimo Di Cesare from Richmond, Francesco Giliberti from OTB, Alexander Albrecht from Ferrero. So the topic of today is, as everybody knows already, this is unfortunately a really significant topic in this historical period, and the transfer price in the era of COVID-19 has been already addressed many times by our colleagues through different webinars and significant events. Today, we go again into this content. Of course, we will start from a general perspective, but then we go into the case study proposed by Giacomo Soldani, and we try to get feedbacks from the other speakers. On December 18, 2020, the OECD delivered the report about the transfer pricing in the year of COVID-19. This is an extension of the OECD transfer price guidelines 2017, but it's just a guidance with a practical, proposal how to approach this extraordinary event. So we will go, that we have four priorities issues addressed by this report 2020. The comparability analysis, the losses and the allocation of COVID-19 in specific costs, government assistance programs, and advanced pricing agreements. So today we will be talking more about chapter 2, about the losses and the allocation of COVID-19 specific costs. And we will be discussing about the allocation of this cost between principal limited risk retailer, if it is the case. We will be discussing about the hazard risk. We will be discussing about the transfer price even governance we have to adopt in this case. So let me say that certainly the COVID-19 has highlighted the vulnerability of the supply chain. And if it's true, the sentence, the tax follows business, we have certainly to take into account how the business is moving because of the COVID-19 and to find the right tax approach to address this movement or these changes, if any, of course. Indeed, we have always to take into account that there is no one solution for everybody. We have to take into account the different industries, the different geographies, the different group strategies. So we have to take into account these specific peculiarities for each of them. So there is no one solution for that. We will just propose today a specific case, and we will go into the details of this specific case in order to increase and to deepen and to, share even thoughts and further arguments how to support this transfer price impact. So my personal view in this case is that we have definitely pay attention on the consistency, because in my personal view, the consistency makes the transfer price policy much stronger and robust than ever. So the consistency, in my view, is something we have to pay attention at, looking at the pre-COVID situation, during what happened during the COVID and post-COVID situation. So this would be, I think, a a good, in my view, but then we will go into the details now in this webinar. It's the right approach to adopt in order to, to face or even to avoid scrutiny in the future or even scrutiny for the past years already. So I don't want to go now into much details, and I'm really happy to leave the floor just to start with our first speaker, Giacomo Soldani. Please, Giacomo. Giacomo is the head of tax of Essilor Luxottica, and we are really pleased to have him with us today. Please, Giacomo.
Thank you, Gianni. Thank you for the introduction. Let me set up the slide. I don't know if you can see it.
Yes, we see.
Okay. So let's start. I would say this presentation is divided in two parts. One is to understand what it is the COVID-19 from a transfer pricing perspective, and the second part would be to address a case study of a limited risk retailer, because what we have seen now, the debate, at least for me, the most interesting debate we are seeing right now is in the case of loss, because as you said, each business had a different impact from COVID. I learned yesterday that, for instance, Parmigiano Reggiano sales were increased during the COVID year. So really each business had a different impact. And the discussion is more interesting to see the business that have been negatively impacted by COVID, how to deal with those losses, in particular with the relationship between a principal and a limited risk entity. This is where the focus is, because I think is also where most of the conflicts between states, and so between multinational and states, will take place in the future. So in order to do that, I would like, first of all, to understand as I said, what it is, the COVID-19, and reading together the OECD introduction, the OECD paper on COVID and TP, and then let's try to apply. So the reference documents are, of course, the documents issued by the OECD, and mainly I would say this last document issued in December on the COVID is more an interpretation document. It doesn't give us anything new, but it gives us the way to read how to address the COVID, but looking to the classic transfer pricing guidelines of the 2017. In particular, let me say, to see what is the COVID-19, we have to look at the definition that the OECD gave to us as another risk. And then we have to go back also to the theory on what it is another risk, and try to read how to address the consequence of the other risk. We should look to the reality, let me say, and we should look at the same time on the explanation that the OECD give to us. But let's start with the first statement. So the classification of other risk, it comes out of the paper issued by OECD in December. Now, this is the statement that you can find in the paper. Now, before reading about the other risk, I would like to better investigate what is another risk. So we should go back to the transfer pricing guidelines issued in 2017. And here, there is clearly in the paragraph 172, there is the general classification of risk for transfer pricing purposes. And by the way, this classification of risk is making, is made by source of uncertainty. So that's why, you have strategic and marketplace risk that are connected to the market, to the economy of the market, infrastructure or operational risk, financial risk, transactional risk, and other risk. So other risk is a risk that stays at the same level of those other risks. And in the definition is clearly there are some elements, because usually in the doctrine we are referring to this as a fire. So it's a single event with a single effect that usually can be insured. And this is, let me say, is the classical definition. However, this definition, in the way it's worded, it does not include only the fire or the earthquake, but include all those events. So also the events that can, but also the events that cannot be mitigated by insurance. So definitely I agree with the declassification of OECD as another risk. But if we move from this theory to the reality, then I would say in the reality, I have noted certain features of the pandemic, of the COVID-19, which, let me say, make me think that this is not a normal hazard risk. This is an unprecedented hazard risk. So really an extraordinary hazard risk. But why? Why so? So first of all, as we said, usually hazard risk may be mitigated by insurance. This is a risk that cannot be insured. And why cannot be insured? It cannot be insured because it cannot be priced. And this is a very important element, and I will come back at the end on that. So no one would have been able to price in an insurance this kind of risk. Second element, it had a very high impact. You know, the impact was on society and the economy in general. And so the impact was very high. And it created, for some business, economic losses, more than assets losses, but for some and also some asset losses. It created reputational issues with the companies. To have, for instance, we can talk about the employee safety. So the company had the trade-off, on making the production going on, but at the same time to protect the people. For sure, as you said, there was an issue about operational aspects. So some business, they have faced a disruption in the supply chain, production and logistics, because of this safety measure, but also because of lockdown imposed by country. And another elements of this is that it went out all over the world very quickly. That is also another element of difference between this and the previous economic crisis. The speed of this virus to spread, but also to spread the economic effect of this COVID around the world. And finally, and I come back to the fact that I mentioned at the beginning, was something that was not possible to price for insurance purpose, but let me say something that could not have been anticipated by third party, because it's not something you can price. And if something cannot be priced means that you cannot manage with an agreement in advance. It's typically something you have to manage only ex post when it happened. And meaning that also in the relationship of intragroup relationship, you have to adapt your policy ex post, because you could have not considered this element in your transfer pricing policy before it, meaning that in the relationship between principal and limited risk entity, you have to face it ex post only. Having seen that, having seen this, let's say these are my observation from reality, I would like to come back then to the theory and see what, after this definition, OECD is telling us. OECD is telling us that this hazard risk has led to unusual outcome of other risks. And so the focus is moved from hazard risk to market risk, operational risk, financial risk, meaning that the economic effects of the pandemic has to be read within the framework that we know. And this is already a big logic step, because it comes in this paragraph 7, but if we move forward, it comes again in paragraph 8, when the OECD repeats that we have to focus on the other risks that have materialized as a result of COVID-19. And so the question that at least came to my mind is this concept correct? So are these economic effects economic effects of the other risk, and we should evaluate those effects in the light that are the origin, the source of uncertainty is the COVID, or we should read within the risk that we know, so the market risk, for instance. And the OECD became even more clear in this example at paragraph 40, still of the OECD paper in December on COVID, where the OECD said, if you have a drop or a decline in demand due to COVID, and you look to your limited risk distribution, then you have to read this drop in demand within the framework of the market risk. So, and here, so it's very clear that OECD, it does not link the drop in demand to COVID to the other risk, but it links it to the market risk. And from this point, let me say, I would like to make some considerations. So the first is that you may consider it not another risk, and you may consider it something that, you know, the decline in demand, for instance, you may want to read through the market risk analysis. However, you still have to consider that this was an extraordinary effect, something that is unprecedented. So even managing the market risk is not a decline in demand you can compare to the previous decline in demand that you had. So it's really extraordinary. The second element that I would like to highlight is that, of course, each business, as we said at the beginning, has a very different impact. So here we are focusing only on the business that have impacted negatively, so on the losses. And in looking to this, we have to consider that there was a lot of changes during 2020. Some of the changes and some of the loss of the business were directly connected to COVID, and some other were more directly connected, for instance, of the changes in the behavior of the consumer. So those are two kinds of impacts of the COVID that we have to consider, when now we will look more into the detail in the relationship between the principal and the retail. And finally, just to touch base on 2021, I think that 2020 compared to 2021, they are really two different years, because 2020, COVID, it happened unexpected, suddenly, and was not budgeted. And this is a matter of fact. On the other side, 2021 is a completely different year, because first of all, it has been budgeted by the company, it has been expected, and all the company and all the business are gonna face 2021 with the 9 months of experience in managing this. So those are different, very different in the 2 years. Now with this introduction, let's make more theoretical, let's see what is in practice, what in practice it may means for the business. So we will focus, as I said, on a principle, and here I'm taking very strong assumptions to make a very extreme assumption that, of course, are not really connected to a real case, because they are a strong assumption, but taking strong assumption will allow us to focus on the key points I wanna focus. So first of all, let me say that we are in a situation, a very ordinary situation, where the TNMM is applied, the ROS as a PLI, so we apply the return on sales as profit level indicator. There are no problem of comparability. Also, this is a strong assumption, because we know the comparability in the TNMM is a physiological problem, but let me assume there is no problem of comparability, meaning also that from a functional profile, we are talking about a retailer that has ordinary function or distribution function and ordinary assets. And also in terms of risk, we have this retailer, we are assuming has the market risk, has the credit risk, and has the inventory risk, has normally have the retailer. Final point that we take as an assumption is that in 2020, the price set by the principal were appropriate, meaning that the result that we see compared to the expected result is the effect only of the COVID. Otherwise, it would have been a good result. With this strong assumption, let's see how an hypothesis. Of course, this case study was written in June last year. However, the logic, is simplified, but it's still a good example, because in this case study, we have only one lockdown period. Of course, reality, unfortunately, is not like this, but I would say it doesn't matter. So in this example, we have said January, February, the retail sales were in line with previous year, and this is a first period with certain economic feature. Then we have from March to May, we had what we call a lockdown period, meaning that the sales were zero because the shops of our limited risk retailer were closed by a government measure, meaning that this is really a loss that has been created in the P&L of our retailer because of a direct consequence of the COVID, meaning direct consequence of our other risk or exceptional market risk. And then in our hypothesis here, we have said that from June to December, there was a slow recovery of the sales. So more in detail, here we have built a kind of P&L with three different periods, which may be addressed from a transfer pricing point of view in three different ways. And this is, the case we would like to share. So first of all, we could say, of course, it's a very simplification. There is no seasonality of the business here, is everything flat. But first 2 months, we had a result in line with previous year. So in this hypothesis, we are making the usual 4% that is, that was the target margin for this limited risk retailer. Then we have, in the lockdown period, we have 3 months where it has a loss. As a loss because, as I said, the shops were closed, and so it realized the loss. Partially the cost, especially if you see selling and labor cost, were offset by state incentives, that was able, like Cassa Integrazione, labor law support, that this limited risk retailer was able to get. And then from June to December, there was still a loss. And here the approach is this loss is not a direct consequence of the closures, but is something to be better investigated. Of course, it could be more something that is in the economic crisis of the situation. It could something that could be connected to the restriction on the mobility of person. But for instance, I want to make an example. It could be also something that is related to the increase on the e-commerce sales. So now I'm not saying that is the case, because of course, if you have an increase of the e-commerce sales, especially in the cases where this increase is managed by principal, then it changes a lot the discussion in the paradigm about how in the relationship between principal and retailer, how to manage the losses. But in this example, so we are taking the position that it could be under certain circumstance, it could be the case that the principal offset only the losses in the post-lockdown period, because the loss of 75 is a loss that is connected to the market and to the country where the limited risk retailer operates, is direct consequence of the COVID, and more important is something that in the future, if the limited risk retailer will come back to a normal, a pre-COVID profitability, will be able to recover quite quickly. So that's why this is a numerical example where you have a case and where you have certain assumption that we think may allow the principal to leave piece of a loss to the retailer. But let's go more into the detail. Which are the elements we have to consider to let's say to evaluate if this retailer can really take a piece of this loss? As we said, an interaction with e-commerce sales for sure is something to be better investigated. But let me say, you also have to understand if the decisions related to the business that were taken in 2020 were made by the local manager or by the principal. Because the assumption here is that all the relevant decisions were made by local manager, meaning, you know, a limited risk entity, but with the market risk, meaning managers managing the market. We have seen in the reality, so we have seen in 2020 many cases where this was not the case, and I would like to mention some examples just to better qualify this assumption. For instance, we have seen companies, especially in the fashion industry, that has taken position like not to benefit of labor law support because of reputational issue. And this, of course, is a decision of the principal, and the principal has to take the consequence. So if you have an increase of cost because a decision with the purpose to protect the image of the company, that's a principal responsibility. Another kind of decision I've seen is companies where, you know, they didn't reduce the cost. For instance, personnel available in the shops. And why they didn't do that, even if they could do that, purpose could be to protect the brand image. So again, so if you want to defend your brand and you keep the same level of personnel, in this example, to defend your brand, and the brand owner is the principal, then the cost of this decision has to be in the principal. And the last example I would like to make is also we have seen that in some cases, the state incentives were linked to the requirement not to pay dividend outside the country. Meaning that if you as a shareholder, and in this case as principal and shareholder, you decide to get your dividend and repay or do not benefit of state incentive, which may be, you know, very relevant. Again, I think here is something that has to be considered because the cost of not having these incentives is a direct consequence of a principal, in this case, shareholder decision in the interest of the shareholders. So also here, there is question mark if you can, you know, really leave the loss to the retailer. Of course, just to mention the post-lockdown period, here is just an hypothesis. You have seen certain number. Each business will have, let's say, will have a different capacity to recover after the lockdown periods. The lockdown period is not just one, we have seen in the reality so many lockdown periods, and also the assumption behind here is that the business model is not changed. And this is very important because, as I said, we have seen in some business the e-commerce growth, which may be not a temporary elements, but a permanent elements, but also we have seen business where the behavior of the consumer has changed. And if this requires a new business model, of course, everything has to be evaluated again. So here, just to make it more simple as possible, we have considered that the same shops are there in the same business, is managed as in the previous year. So at the end, the question is if these limited risk retailers can have a piece of the negative financial consequence of COVID, and if they can support this piece, which is the amount that can be given to them. One of a final element, because I think if we look, then we will come back to the numbers, is that also looking to the, let's say, the general transfer pricing guidelines, one of the elements to see if you can support the risk in the paragraph 198 is to have the financial capacity to absorb the risk. So the question we should address is, once you have identified the loss that potentially could stay in the limited risk retailer because it's directly connected to that market, to that shops, you should check whether there is this capacity to recover the loss. So if the limited risk retailer has the financial capacity to absorb that risk. Here, there is a big question mark. How long, what is a reasonable time to recover the loss? I mentioned here 1 to 5 years, but is really open for debate because it's really business specific. So this is just very general indication. Of course, there are other elements to evaluate the loss, and this is the reasonability. You may double check with another transfer pricing method. You need to ensure exactly what you said, Gianni, a consistency, the way you approach. So you have to be consistent with the past, even if it has been an extraordinary event. But you may not change, the method or the function of the risk and everything if it's not really change. So consistency with the past. And of course, it's if you play with the allocation of risk and you create aggressive position in terms of tax, this is also another element that could be negatively be seen by tax authority. So if we come back to the numbers, all these elements, I think that there are cases, and this is, I repeat, is not something, there are cases which under certain circumstances, piece of the loss can be left in the retailer. And in this case, what has been the assumption behind those numbers is again that the loss of 75 is the loss direct connected to the other risk, so it's and connected to the market, and the post-lockdown period, the principal cover the loss up to the break-even, assuming that the break-even is the result of the revised benchmark. So here there is also a timing issue. Now I don't want to go too much into the detail, but all the groups they take decision in December, and they do not change after 1 year, because this is very complex in international transaction to change only the tax return. So we have taken decision based on previous benchmark. You could revise the benchmark with certain adjustments. You don't have available 2020 data, but you could say, let's say in this simplification, I could say that we have looked to the full range instead of the quartile, the quartiles, and so 0 was the minimum, and so we have revised the benchmark and adjusted as it was a drop in demand within the market risk analysis. And so that's why our retailer rate ended up at 67. So let's try to conclude from this case study and to maybe to recap which are really the elements that we should consider, and I put on the table also for the debate with my colleagues and friends here, and let me try to recap all the elements I think we should look at to make this evaluation in the relationship between the principal and, in this case, the limited risk retailer. Of course, the first, as I said, is that our retailer has an ordinary function and ordinary asset, and has the market risk, credit risk, and inventory risk. So it's normal. In addition to that, the assumption is that the 2020 loss we are talking about is the direct consequence of the COVID. So in this case, we are shops closure because of government laws that implemented that. Other strong assumption is that business decisions, as I said, were taken by local manager and not by the principal. Also, we have assumed that our retailer was able to benefit of the tax incentive enacted in each country. And let me say finally that the retailer has the financial capacities to absorb the loss that we have identified in this case to stay in its P&L. Now, these are, I think, are the key elements to have this discussion. There is another element that very often is discussed in our community, and that is that someone is focusing on looking to the relationship between principal and limited risk retailer and says that we should look to the combined profit and loss of the transaction. So someone is saying that only if also the principal is making a loss, meaning that as a group they are making a loss can be attributed to a limited risk retailer. I personally here I'm taking a different view in the sense that I do not think this is a conditions. I think it's one of the elements that should be evaluated in the context of all other elements. Also because very often when you take this position, you may say that you want to split the loss based on the split of the profit. And this, it may sound a good comment, but let me say has a practical application to certain cases, which is very awkward, because you may have in a lot of business principles that are selling at cost to make the 4% in the limited risk retailer, because this is the way that TNMM may work, especially in the market where you don't have too much profitability. So what is the pre-COVID situation? The 100% of profit is in the limited risk retailer in this case. So if you split based on the allocation of profit, you should give all the loss to the retailer, which it become a kind of let's say of nonsense to a certain extent. So I think I can conclude here. I think I have touched all the elements to open the debates. Of course, these are elements, as I said, that require really a customized evaluation for each business, but I think are the criteria to go through when you have a discussion on that argument. So I give you back the floor, Gianni.
Thank you, Giacomo. First, please let me say to the participants, if they want to do some questions, of course they can just do the question on the D and R icon over the screen. So it would be the Q&A in English. So thank you, Giacomo. I have just one question because I was going again through your slides, and you know, about the e-commerce. There is definitely an increase of the e-commerce sales, as you said, and there could be even a different position about that, because you say that this increase can shift a portion of the operating margin from the principal to the retailer, since in somehow through the e-commerce you have been able to cover the geography where the retailer was closed because of the COVID-19. That could be a different position that we'll see later on in our presentation today. But just a feedback from your side, if you can, is how do you see that the opposite position where there is less involvement for the e-commerce sales for the limited risk retailer, and then since it is less involved, maybe there is no portion at all to share with the limited risk retailer, since the principal made an increase of this e-commerce by himself. Do you see my point?
Exactly. Here, let me say, Gianni, you really need to see to the business. I make you an example. You can have your e-commerce platform usually managed by the principal in all Europe. And in a country, I don't know, like Portugal, you don't sell too much. Then you start to build your shops and your sales, e-commerce sales grow, meaning that it's true that it's e-commerce sales, but it's based on the physical presence of the shops, on the brand building that the shops are doing, on the services, you know, on repair and changing products. So you really need to, the business, they know what is the interaction. That's why, you know, if you are in this situation, I'm telling you, where, you know, you have seen a growth in sales of e-commerce, but based on building also the shops, when the shops are closed and there is a clear shift of sales from the shops to the e-commerce, I think as a principle, at least you should ask yourself the question, should I recognize part of this profit to my limited risk retailer? Because it's coming from the fact that those sales are coming from the fact that the shops are closed.
Yeah, I agree. And okay, about also the loss recoverability, actually, because of course you made this range of between 1 and 5 years to recover the losses. It is also, I think, I totally agree with you again. This is again based on the business itself. It depends on the business, on the industry as well. In any case, this is my comment. Even though this period should be longer, as long as the TP policy is consistent, I think this is a strong argument anyway. Because of course, if the time is, you know, the recoverability takes time, more than 5 years, that definitely can recall the attention from the local tax authority. But this is again important in circumstances to keep the TP consistent by itself. This is my opinion on that side. Okay, so there is no so far no questions. So I will say,
Gianni, I have a question for Giacomo, if I may. When you talk about the hazard risk before, you said that one of the differences of COVID compared to the normal definition of hazard risk is that we might not have insurances ready to cover the COVID issues. And this is an important difference. In transfer pricing, sometimes we conclude that when you don't have anyone that would be able or available to enter into a transaction intra-group, then eventually the tax administration might disregard that transaction. And so do you see the risk that eventually in some situations the tax administrations of the parent company might conclude, look, since there would not be any insurance ready to cover the loss of the subsidiary locally, I would not recognize this transaction as a valid one. On the other hand, of course, in reality, we have seen that during COVID, even between third parties, there were situations in which, because of the specific period, some contracts that were not respected, or not all the conditions of the contract were respected. In some cases, clients or suppliers were asking for discounts or other sorts of topics, and they were allowed. So what is your view on that topic?
No, thank you, Raffaele. I think you touched the point which is going to be, you know, the source of litigations. Because in my view, there is no doubt that agreements, especially intercompany agreements, has no value. I mean, can be changed. I mean, we have seen businesses where we have renegotiated all the agreements with third party, also with the landlords or real estate. So you can imagine commercial agreements. Having said that, the fact that cannot be covered and the fact that the loss is in the hands of the limited risk entity, this can be used by the tax authority of the principal to say why you cover it. you were not entitled to cover. So I do not recognize the transfer price adjustment you are giving to your limited risk retailer because you don't have legally the obligation to cover it. Exactly the point you say. On the other side, we will see, and this is, I would say, the tax authorities that are gonna check the limited risk entity will found full support on the CD approach to say, look, it's not other risk, it's market risk. So in the past, all the profit were kept by your principal. Now your principal has to pay for the loss. But exactly this point will allow, you know, the two different perspectives from the two tax authorities, which create litigation. I don't know if I answered to your question.
Perfect.
Thanks.
We have a question from the participant, Giacomo. So the question is, would it be possible to analyze the post-lockdown period in a relative perspective? Since in complex and large countries, lockdowns established by local governments would be still existent in some parts of the country only, as in other parts the reflection would be indirect economic crisis. There would be a mix of reasons, many times difficult to determine and individualize it.
Yes, this is really, you know, the reality. I agree with the participant that is making a point about complexity in the reality, which should really case by case take different approach. So you can try to make a segmented P&L in the same year, but you could take also in the country where it's possible to take an approach of multi-years, you know, so that you put together lockdown and non-lockdown period, but in a long term to guarantee a certain average, you know, try to benchmark in the long term your business. So there are countries like in US where you can look at the numbers from a transfer pricing point of view in the 3 years. This will help to stabilize. But there is no clear answer on that. The complexity is something, you know, you have to face business by business.
And geography by geography in this case.
And geography by geography.
Yeah. Okay, thank you, Giacomo. Let's go ahead with Professor Raffaele Petruzzi, Managing Director at WU Transfer Price Center of Vienna. Please, Raffaele.
Okay, so thank you very much. Thanks, Gianni, for the kind invitation. I hope you can see the presentation.
Yes, very well.
Yeah. All right. So thanks a lot for the kind invitation, and thanks for calling me professor, although I'm not a professor, but I take it as a compliment. And thanks for that as well, and thanks for inviting me to this great event. I will try to stay in the 25-30 minutes as agreed, but I hope there will be time also for questions. And if you have any during my presentation, in the course of the presentation, please feel free to ask. The idea here would have been to look at the various issues related to COVID-19 from a broader perspective. Of course, Giacomo has gone into a lot of details related to the hazard risk and the case of loss attributions to limited risk entity. What I will try to do is to look at other issues eventually that could raise into this period. There is this great guidance by the OECD. It's an impressive work because it was done only in few months, and the OECD has managed to reach an agreement with 137 countries of the inclusive framework. So a really impressive work on that, although of course the guidance does not cover all the issues or a lot of other issues that could have been covered. Of course, lack of time might have been one of the reasons for that. In the meantime, also other tax administrations have provided guidance. For example, before the OECD provided guidance, there were tax administrations in Singapore, in Australia, in New Zealand. I guess to some extent also the US tax administration, but maybe Professor Brauner will comment on that. But anyway, some tax administrations have provided some guidance before the OECD. Probably the Italian tax administration will do as well, we don't know. But we will see during this discussion what has been the approach suggested by the OECD. So when we look at the impact of COVID on transfer pricing, I guess the COVID-19 issues have involved the entire transfer pricing analysis and not just the issues related to comparability. We start usually with identifying the commercial and financial relations in transfer pricing, so finding out what the real deal is, what are the contracts there between related parties, whether they are in line with the conduct, with the reality of the situation. And in here, I think COVID will have an impact, medium strong impact on the identification of commercial and financial relations, because of course the 5 economically relevant characteristics will be investigated, and probably some of them will not be as they were before COVID. The second step usually of a transfer pricing analysis is to recognize the accurate delineated transaction, the topic that we were discussing a few minutes ago as well with Giacomo. I think in here there will be a strong impact of COVID-19 because, as we said, tax administrations might have different views. Some might say, I do not agree with refunding the losses at the local level. Some others might say, at the local level instead, might say, look, I usually don't get the profits, the residual profits, so why should I get the residual losses now? And so there might be issues that go really much into this discussion. Not to forget the fact that COVID-19 has not changed only the level of profit or losses of limited risk entities, but also there has been some restructuring in supply chains of multinationals. Some companies have also seen their employees moving between countries, going home and work on remote. There has been an acceleration in the digitalization also of the business models of companies. And all these discussions probably will, in some cases, end up in finding out whether there was a business restructuring even in place with all these changes. The third step of the analysis is the selection of the most appropriate method. In here, I would say the impact of COVID-19 should not be too strong, because usually if the identification of commercial and financial relations has not changed, then the method should not change either. Although I've heard in some cases saying, since we have losses now, we should not use the TNMM, we should use profit split. I honestly do not agree with that. I think if the method was the correct one before our analysis in COVID times, and if nothing has changed, or if the circumstances have not radically changed in some cases, then you should not change the method either. And last but not least, we usually apply this method by means of a benchmark analysis, by means of comparability analysis, by means of CAP. And I guess, as we've seen also with Giacomo, this will be impacted significantly by COVID. And this is where the OECD has been focusing mostly in its guidance, and this is what I will cover in the rest of this presentation. When we look at the short-term impacts of COVID, I think the long-term impact of COVID will be much stronger, including in the transfer pricing analysis. But when we look at the short-term impact of COVID, which is what we will discuss now, we see various levels of transactions and various situations in which COVID have impacted our transfer pricing analysis. First of all, the OECD makes it clear that if nothing had changed, if we had pre-existing agreements, if facts and circumstances have not changed, and if third parties would not have changed those agreements, then we don't need to change anything. And I think this is an important point because it shows us that we don't always have to change everything because of COVID. In some cases, we use COVID as an excuse for changing things, but in many cases, we might not change anything. Although it's also true that this is most of the time a theoretical scenario, because COVID has changed indeed at least the facts and circumstances, because some of the comparability factors have changed. What will be strongly impacted by COVID is intercompany transactions that were not covered by pre-existing agreements. Because of course, in those cases where you did not have any agreement and you're starting a new transaction in 2020 or 2021, then the question is, how do I behave? Because I'm starting something new in a period of economic instability. And so where do I find the way that unrelated parties would act in normal circumstances if I'm acting in abnormal circumstances? And everything in the middle is what we usually are discussing. So the situations in which we had pre-existing agreements, but facts and circumstances have changed. And the question here is, what has really changed during COVID? Economic circumstances, most probably they have changed because, of course, COVID has impacted in all the significant economic life of every country, and so the economic circumstances have changed. Characteristics of property and services, this might have changed or not. Maybe we have to find out whether we provide the services, for example, in the same way that we were providing them pre-COVID. Business strategies, we might need to look at also this changed as an outcome of COVID. In some cases, companies might have changed their strategies, even their business. In some cases, we have seen companies that have started manufacturing something different when it was coming to some, for example, products anti-COVID. I imagine, for example, the cases of the masks, and also contractual arrangements might have changed during COVID. As we said before, even if contractual arrangements between related parties were not foreseeing any specific COVID clause, because no one was expecting that, indeed, we have seen that unrelated parties have changed their behavior even where there was no issues foreseen in the contract, and this is something that related parties should take into account as well. Last but not least, I think the functional analysis will need to be checked, whether functions, assets, and risks have changed. And in this slide, I've put it in a different color, because as we know, when functions, assets, or risks change, then we might have a business restructuring. So the impact of COVID is much stronger. So if we find out that after COVID or during COVID, we change the functional profile of our entity, then of course the impact is much stronger. So this slide shows that, first of all, not everything should be changed, but in the moment that something has changed with COVID, we need to really question what really has changed in our specific circumstances. Just to make things more complicated, of course, we have to think whether we are working with a centralized business model or decentralized business models, whether we have limited a principal and a limited risk entities locally, or whether we have full-fledged entities locally. And of course, the impact of COVID will be much more difficult to analyze. What type of transaction we have, whether we are dealing with transactions related to services, or whether we are dealing with financing transactions, with intangibles, whether our DEMPI analysis have changed during the COVID times. whether we are dealing with a so-called winner or whether we're dealing with a loser. Some companies have been gaining from COVID, as we know. Companies in the internet industry, online retailers, stay-home companies have actually won. And so they will have extra profits rather than extra losses. And this is something that we need to understand how to attribute them during time. Whether we use a one-side or a two-side method, of course, TNMM is something that will have a lot of difficulties in being implemented during COVID times. But probably if we use a CAP, comparable control price, we might have better evidences and real-time evidences of how third parties have behaved also during this COVID situation. What was the impact of the government assistance program, whether these subsidies should be transferred or not to other entities within the group, whether we have available data at our disposal. And in this regard, for example, when we look at the way that TNMM is currently implemented by means of pan-regional studies, we should not forget that even within the same region, if we think of Europe, countries have acted differently, and the economic impact has been different. And so does it still make sense to run pan-European studies or pan-regional studies, or should we more focus on local comparables because there are differences, as was mentioned also in the question before by the participant, even within the same country? Whether we can make adjustments to the data or not, this will be an important factor to be assessed. And last but not least, the big question will be how third parties would have behaved, how third parties have behaved during COVID times. The OECD tells us that there might be some information that you can use in order to somehow assess what the impact of COVID has been during these times. You can look at how sales volumes have changed. You can look how the capacity utilization has changed. Of course, entities with high fixed cost will have bigger troubles in recovering compared to entities with lower fixed cost. What information we have with reference to incremental or to exceptional costs, the impact of government assistance, we said it already. The OECD says that also information from interim financial statements might be useful for our purposes. So just looking at interim results and how they have changed might allow us to get a better understanding of our comparability in 2020. Macroeconomic information, they could be used as well. We have seen that eventually GDP might be a good factor to understand how profits change, because in various circumstances, GDP is aligned with the results of companies in those countries. Statistical methods, of course, those are more complex methods, but they can also be used, says the OECD. Something that is done by many companies now is to look at a comparison between the budgeted internal data and the forecasted data, and of course the differences might give us an understanding of how the results should be adjusted at the end of the year. And last but not least, the OECD also tells us, look at eventually what was the impact of previous recessionary periods. For example, the financial and then economic crisis starting in 2007, 2008. This could give us an idea, although the OECD is a little bit careful with that, because says that, of course, the impact of that crisis might not be the same as the impact of COVID. Here, just an example of something that was analyzed pretty much already by Giacomo, so I will not go into details. This is an example of a limited risk entity. We have Delicious Pizza, is an Indian company, part of Pizzageddon Group. There is an Italian multinational producing pizza in Italy and selling it all over the world, thanks to special techniques allowing the product and its original flavor to be preserved for longer periods. The group is famous for its unique light flavored pasta and employs 10,000 pizza makers in 50 countries. Prior to the lockdown in India in March 2020, Delicious Pizza employed 500 people distributing pizza exclusively to Italian restaurants in India. According to the 2019 documentation, Delicious Pizza was functionally characterized as a limited risk distributor. This was confirmed by the function analysis and reflected in the analysis of the conduct of the parties. The TNMM was used as the most appropriate method, and it was calculated that a return on sales of 10% confirmed by a benchmark analysis was a proper remuneration. Now, when India announced the lockdown and the subsequent closing of the restaurants, Delicious Pizza stopped all the distribution activities, and obviously the various lockdowns and interruptions of activities at the group level generated a loss of 80% of the sales, and in India this reduction was 60%, and this sales reduction generated a group loss of 2 billion in 2020. Then of course all the issues that were already analyzed before by Giacomo need to be assessed. In this case, what the OECD tells us is that you have various approaches you could use. First of all, the OECD always tells us use a reasonable commercial judgment. This is something that we should aim at doing all the time, not only during crisis, but also in normal periods. Another approach that the OECD suggests us is to look eventually at an outcome testing approach. So look at what happened at the end of 2020, also based on data that you might get during 2021, especially if you are still on time to amend those data. Now, that much depends on the specific legislation of the country, whether countries allow or not to make adjustments ex post. And in my view, this has pros and cons. You have the pro, of course, of getting real-time data for your benchmark analysis. Cons are the fact that you might find the other country not giving this approach, not granting this approach, and then you are stuck with one country that allows you to use real-time data and the other country that does not allow that, and so you have different results and you don't know how to come out of that. Apart from the fact that an ex-post approach always gives issues with VAT and customs. Use more than one method. This is something that you might consider doing. Usually in normal periods, you use a cap analysis when you can apply the cap, and then you apply TNMM of profit split in order to have a corroborative analysis. In this case, during COVID, probably you will use a TNMM and then eventually a cap, since a cap gives a more updated results compared to the TNMM, in order to confirm as a corroborative method the TNMM. Use of multiple periods, of separate periods. This is, of course, something that was explained already by Giacomo. In some cases, you can use multiple years. In some cases, you might take analysis of the years not of the months within the year not impacted by COVID and others impacted by COVID. Make adjustments. In this case, you have to question whether you want to make adjustments to the tested parties, whether you want to make adjustments to the comparable parties, whether you want to use macroeconomic or microeconomic, as we said already before, factors in order to make those adjustments. Review the set of comparables Again, TNMM works well in stable economic period, does not work that well during this unstable period. And so the OECD also says to suggest to use loss-making comparables. There is also another element, another approach that could be used. Instead of focusing, as we usually do, especially in Europe, in our benchmark, on companies that are not parts of groups, maybe we can do something that I guess is more used in the US, where we might use data from groups and look at the profits of the groups as an arm's length profit, because they are not influenced by intercompany transactions at the consolidated level. And that could be also another approach that could help us in understanding what the impact should be of COVID on our benchmarks. So just to conclude, COVID has impacted all our transfer pricing analysis, not only our benchmarking or comparability analysis, and all the relevant transactions. Of course, now we often deal with issues related to services, especially when we have a limited risk services, but we have to look also at issues related to financing, whether in this period you can have a loan, or whether you are having that loan just because you are part of a group. What is the impact on the interest rates in these times? And so these are all considerations that we need to make. As I said, I guess COVID will have much more far-reaching consequences in the long term, and right now we are just focusing on the short-term impact, but on the long term we might see people changing the way that they work, changing the place from where they work, and that will have an impact on our DEMPI analysis, on our function analysis in general. Different approaches for different situations. We have to think of whether we are winner or losers, whether we are decentralized or centralized, and so all these questions will need to be assessed. Do not lose track of what third parties do or would have done. This is extremely important in COVID times, because otherwise you might end up reaching conclusions that are out of the way that third parties would have behaved. What would be the impact on the OECD project on digital? If we think that now the OECD is trying to come up with a solution under Pillar 1 that says, okay, with amount A, we give extra profits to market countries. Are we sure we have extra profits to give to market countries? And secondly, under amount B, we want to find out a fixed margin, a fixed return for limited risk activities. Are we sure we can define that fixed return during this period where we cannot even make a reliable TNMM analysis? We will see. Risks of permanent establishments. The OECD, of course, said already that when you move temporary people in other countries, you should not have permanent establishment issues. First of all, the OECD still is not a lawmaker, so countries might act differently than what the OECD has suggested. Secondly, what is temporary? This is something that countries might interpret in different ways. If people have been moving for more than half of the year, then maybe we will see more and more tax administrations complaining about that. Impact on customs and indirect taxes. This is absolutely something that we need to consider many companies, and the TNMM analysis usually, especially when doing ex post adjustments, might end up in having not that reliable results for customs and indirect taxes. The only solution that I see here is improving dialogue between taxpayers and tax administrations, and for that, of course, please let's not use our handshakings, let's use our new ways to agree with each other that we have developed during COVID times. So I hope that was interesting enough and clear. If you have questions, just ask. Otherwise, you can contact me after the webinar.
Thank you, Raffaele. Waiting for some questions, if any, from the participant. I think already we have one. Sorry, could you please repeat the conclusions in regard of the impact on the OECD project on digital?
Yes, so the OECD project on digital, I will just briefly mention it, otherwise we would need another workshop for that. But under amount A is saying you need to give more taxing, more profits to the market jurisdictions. And if you see the way that amount A is currently designed, mostly looks at situations where you have profits and does not look that much into situations in which you have losses. There is there in the new paper something in order to take into account previously made losses, but this is not yet defined. I don't know how countries will agree on that part. But still, since amount A looks at situations in which we have losses, then probably we will not have that many profits to give to the countries, at least during 2020 and 2021, because a lot of companies are not making profits, simple as that. And so countries might be disappointed by the outcome of amount A. As for amount B, we have the concept of using fixed margins for limited risk distribution activities, and the OECD is working on these fixed margins. But of course, if now we are living unstable periods, then it will be difficult to imagine how we can conceive new fixed margins in cases where we have so much uncertainty with the normal TNMM analysis, where we look at fixed margins for limited risk activities. So this is just a couple of considerations on that project.
Raffaele, just one question, because you were briefly talking also about the business restructuring, and in one slide you of course emphasized the key role of the functional analysis, because now of course we are talking about more about the locational risks, but this is just part of the entire functional analysis. So we have to always look at the functions, asset, and risk indeed. But there might be concern about the fact that because of the COVID-19, there could be a business restructuring in the same time, which actually could bring it to even further tax issues, as you said, because this is a concern that actually I see. So I think we need, let me say in this way, and let me know if you agree on that. I think it's important to stick to the TP analysis, even TP structure as it was even the pre-COVID, with the, of course, adjustments due to the COVID-19 now. But if we stick to that, maybe there is no business restructuring because the functions are not changed, let me say in short. And then we do not have any further tax exposures or issues to deal with. So this is, I think it's important to emphasize, because it's easy to follow I don't want to say mistake, but into this matter, because just making even a slight change of the functions that it can be later on, recognized or qualified as business restructuring, which actually can create even more problem to the company. What is your point? What is your standpoint on that?
Yes, I guess, I mean, I did not mean to say that now during COVID, everything will be a business restructuring. Actually, I wanted to say the opposite. I wanted to say that in most situations, things have not changed to the functionalities of companies, and therefore we should stick to the delineation of transaction we've done before and to the method that we have adopted before COVID. But in some situations, companies might make long-term changes. For example, in some cases during COVID, companies have dismissed some of their employees. They found out that they were working with too many employees, and because of digitalization, probably this new, this old ways of working will not be efficient for many companies, and in the future, COVID has accelerated a lot of changes that the companies had in mind already before COVID. And so in cases of long-term changes, in case of long-term radical changes, then we might expect that this will be characterized in certain situations as business restructuring. So of course, we have to verify if there is also a loss or profit or loss potential in order to make a business restructuring. So in order for a business restructuring to happen, you not only have to have a movement of functional assets and risks, but there should be also a loss of a profit potential there. Mm-hmm. And in some cases, cost savings might not be necessary the reason for having a loss of a profit potential. In other words, if the company, the way that it was going ahead before with the previous business model would not have survived after COVID, then of course you might not need to assess any business restructuring, because you are making that changes in order to make the company surviving, compared to the scenario where it would not have survived because it would have had the same and the old business model in place. So these are changes that will not happen all the time, and most probably they will not happen in most of the situations, but in some cases they might change and it might happen, and we need to take them into account.
Yeah, thank you, Raffaele. And then I go the floor to Professor Jarek Brown. Please, Jarek.
Hey everybody, and thank you. Can you see the slides?
Yes.
I also have to apologize for leaving early, but I have a pre-scheduled class, so this is where we are.
No problem.
So my perspective, I think, will be a little bit different from many of the others. Of course, they have an advantage over me in the sense of what may be practical in their particular business, and obviously we understand that really every business is going to have to deal with a very different reality in different countries, etc., etc. But I want to generalize it a little bit. In my opinion, what's really important to mention here is that the COVID-19 pandemic is not is not a hazard risk in its regular sense, and not just because of the technicality of whether it could be insured or couldn't be insured. It couldn't have been anticipated even by the really dramatic, very detailed financial analysts. So, for example, when you have cyclical economic downturns, of course, this is something that companies know how to deal with, and governments think they know how to deal with, and that's something that is difficult to insure for, difficult to prepare for, but this is something we expect companies to adjust to. I don't think this is the case with COVID. I think this is a market disruption, and it is of a such that exposes our dependence on arm's length that I will disclose, and many people may already know. I think it's really a fiction. It doesn't work intellectually, even today. Nonetheless, during the pandemic, arm's length completely collapses. Why? Because it's market-based. It's kind of based on locality, because it involves enforcement by particular countries. and it has to be continuous and dynamic for it to be in any way practicable. And during the pandemics, all of these really collapse. Now, this does not mean that there aren't companies that could continue and apply the transfer pricing strategy with relatively small adjustment. Of course, it's possible. But at the conceptual level, I think this is particularly difficult. So if we divide the world, let's say very arbitrarily, to the pre-pandemic, to 2020 and 2021, and let's just put them together, although I agree that we may need to distinguish between them, and then from now on. So there could be companies that could just use these 2 years as special years and will require consistency between the pre-pandemic and the post-pandemic. But of course, as we know, a lot of businesses under normal conditions are going to have to restructure and or are restructuring, as Rafael just said. So I think the proper model, maybe the standard model, should be of restructuring or a startup model, a business change model. It is completely fictional to me to assume adjustments to the terms of the contract in the way that an arm's length business requires, right? I mean, you know, what third parties will do? Well, we don't know what they will do. We just know what they have done in the particular situation for the particular business. And of course, to take into account the very different situation in different countries. So what do we do with this? In my opinion, in this particular situation of COVID and the example given to us by Giacomo, I think it makes a lot of sense to go into a model of proportional burden. Remember, in the end of the day, transfer pricing is here to prevent abuse. It is a regulatory tool imposed by a government to prevent abuse. And what the taxpayers must do is to survive in this environment. I understand that, but from the country's perspective, the country must accept that there will be some kind of burden in terms of revenue if there is some business operating in the country any subject to the transfer pricing rule. So for example, if you had a limited risk distributor, there should be some limits on the amount of losses that you assign to the limited risk distributor, if at all. However, from the taxpayer's perspective, I think there should be a lot of leeway for them to explain the particular situation. So if we go more specifically, I think cost-based analysis doesn't make sense at all. I think transactional methods must continue to be superior. And if we have a problem with TNMM, to me, the alternative is not to go to CAP, because CAP doesn't make any sense in times of real turmoil in a pandemic. What are you going to look at? You're going to look at other companies that struggle again similarly with pricing in an uncertain time. That is not arm's length. Others have mentioned the use of local comparables, and I think that's really important. Both Giacomo and Rafael talked about who makes the decisions. To me, I am a little bit hesitant about that, because come on, what does it mean who makes the decisions in a group that is rather cohesive? It makes complete sense that certain decisions is made at the level of the group, but still have to be shared even with a limited risk retailer. So if we move from a regular retail into some e-commerce, the benefits are going to be shared throughout the group. It's a complete change of the business model. So the fact that these decisions are made at the level of the group, I don't think should punish the group in terms of transfer pricing and risk of audit, for example. Same thing about the dogmatic distinction between a lockdown and a non-lockdown. Not that I have any opposition to the specific example. The problem is that we need to specify what is the exact situation in each country, in each of these, on each of these periods. I think obviously we operate on an annual basis. And that requires annual transfer pricing reporting. But during the pandemic, we have a specific obligation to accept, from a country perspective, to accept a multi-year analysis and adjustment mechanism like we use in terms of losses. In the United States, this is, I think, more acceptable than in other countries. But again, that should be something that both companies should be able to show, and for government the obligation to accept these type of mechanisms. And when we talk about comparables, again, it is likely again that countries will want to have local comparables. The problem with local comparables is that normally we don't have a lot of them. And that is a really dramatic problems that I think could only be resolved on a combined group basis, because that will preserve the fairness of the division of the tax base between countries and provide the reasonableness and therefore the protection from the country applying some anti-abuse mechanism embedded in the transfer pricing rules. The same thing goes for excessive profits. I don't think they should be trapped locally and impact future business models once they disappear. Others talked about state incentives. And I'll just add, again, with respect to comparables, that in the COVID situation, there will be even an increased survival bias, right? We're not using real profits in reality. We're using profits that are available to us and profits that are available from relatively successful surviving companies. And that would be even worse in the times of the pandemic, which again takes us away from COP, from typical arm's length rhetoric, like I described before. That's it for me.
Thank you, Gary. Thank you. Let's see if there is any question. It's interesting what you said when you were talking about who makes the decision, actually. So as far as I understand from your statement, you said it's more important how the functions, asset, and risk are then split after the decision is made, whoever made the decision, right? At least for transfer price purposes. So there is a question, actually, is about in countries where the exchange fluctuation is more sensible to crisis, being heavily affected by the pandemic situation, and having their currencies to 30%, 40% devaluated, like in Latin America. In a limited risk retailer, which imports and resells, sales and or margins would be deeply impacted. Would this be individual analyzed as specific COVID effects or be part of the general macroeconomic reasons?
Well, to me, it seems, no, of course, there are macroeconomic impacts that may coincide with COVID, but in this sense, we have to be kind of practical in the sense to delineate the two could be very difficult. So take, for example, a country that happened to have a political crisis that coincide with the COVID, right? How do you delineate the two? I mean, not to insult or not insult my Brazilian friends on the call, this seems to be like a really good example. They have a tragic example. Hi, Luis. So at the same time, you have several political events that can impact obviously your transfer pricing and your economic analysis. And regardless of what you think about this politics, but some of the political crisis is related to COVID, of course. And you experience maybe the most tragic at this point spread of the disease. To me, to try to delineate the two is not sensible. This is not economics. And therefore, the practical solution to here, in this particular case, will be to look at the combined effect and attribute it to the extraordinary circumstances. So to say that you know, the taxpayer could have anticipated the political change and therefore they shouldn't be allowed to compensate in terms of allocation of losses in Brazil, for example, seems to me senseless. And not consistent with arm's length if you believe in, even if you believe in arm's length.
Thank you, Yair. Thank you. Sorry for being a bit late. Thank you for being with us. Let's give the floor to Andrea Ballancini. Can you share by yourself? Okay, perfect. Thank you. The audio off.
Here we go.
Okay, perfect.
Thank you. I would like to thank Gianni Vivona for the invitation and to be part of this prestigious panel. I would like, I try to stay in my 20 minutes, and I would like to talk about the possible Italian perspective, As already stated, the OECD guidelines addresses four main issues that, although presented separately, may require anyhow an interrelated scrutiny. The importance of the OECD guidelines is due to the fact that, of course, it represents the consensus of the 137 members of the inclusive framework on BEPS, and thus it should include also Italy, which is of course a member of the inclusive framework on BEPS. So let's say the OECD guidelines on the transfer price implication should in a way represent also the view of the Italian tax authorities, but who knows? We will see that there might a lot of problems and issues may arise in Italy. Let's start from the first point that is touch upon the OECD guidelines, the comparability analysis. Of course, finding proper comparables for the fiscal year 2020 would very likely represent the most common and frequent issue that groups have to address in the near future. Considering the very specific circumstances generated by COVID, financial data, 2020 financial data of independent companies are probably the most reliable source of information. However, as we know, such information, the 2020 financial information, will not be available at year end, when many groups, most of multinationals in general, perform the transfer pricing adjustments. Therefore, the group cannot, in theory, use the 2020 intercompany prices. In this regard, as already stated by the previous speakers, the guidelines suggest some practical approaches to overcome the deficit of information. And in the slide, you see the four approaches that are suggested by the OECD guidance. As far as the third point, namely the use of more than one transfer pricing method, as already Raffaele pointed out, I would like to stress the fact that the use of more than one method may be, of course, helpful to further corroborate the results, keeping in mind, of course, that any additional method anyhow should be consistent with the functional analysis. Therefore, also from an Italian perspective, if the most appropriate method, let's say it is the TNMM method, then we could, yes, of course, use another method, let's say the profit split method, as a corroborative method. But if and only if a functional modification is incurred. As we know, the OECD transfer pricing guidelines describe two approaches to identify and collect data. The first approach is the so-called price setting approach, let's say the ex ante approach, which uses historical data updated to reflect any change in economic conditions through the date of the contract. And the second approach, the ex post approach, the so-called ex post approach, which incorporate information that becomes available after the close of the taxable year in order to determine, to fix the arm's length conditions and report the result only in the tax return. The guidelines, the December OECD guidelines states that where possible, tax authorities that otherwise use the price setting approach, the ex ante approach, could consider allowing taxpayer to use a ex post approach. And so give the opportunity, the possibility to make a downward or upward adjustment only in the tax return, although such adjustments are not being recorded in the balance sheet, in the profit and loss account. In this respect, the Italian domestic law, as we know, allows theoretically for the application of an ex post approach, but only as for the upward adjustments. Since Article 10.10.0, paragraph 7 of Italian tax code provide for the non-recognition of compensatory tax adjustment, downward adjustment. So a downward adjustment that has not been recorded, that has not been booked in the balance sheet, cannot be made directly in the tax return. Only in very few circumstances, such as the pursuant to a mutual agreement procedure, is possible to make a downward adjustment only in the tax return. So there is very few cases where the taxpayer can make a downward adjustment directly in the tax return without a recording in the balance sheet, in the profit and loss account. We know that Article 31st Quarter of the Presidential Decree 600 of 1973 has been amended last year in order, in a way, to encompass other cases, but still are very few cases where it is possible to make these downward adjustments. So this is a very big issue for from an Italian perspective, that in a way could render the ex post testing approach advocated by the OECD guidelines impossible to use in Italy as far as the downward adjustments are concerned. So from a practical point of view, one suggestion could be to make negative adjustment, downward adjustment directly in the balance sheet, in the profit and loss, and to leave the door open to make eventually a upward adjustment in the tax return. Treatment of losses. As already Giacomo and also Raffaele pointed it out, from the OECD guidelines, give the possibility to use also loss companies as comparable. In a way, in this line, also the December OECD guidelines on COVID implications underlines that when performing a comparability analysis for financial year 2020, it may be appropriate to include also loss-making comparables. Well, of course, the delineation of the transaction indicates that those comparables are reliable. For instance, because the comparables assume similar levels of risk or have been impacted by the pandemic in a similar way. What is the Italian perspective? What is the Italian approach towards the treatment of losses? The Italian legislator, namely the the decree of May 2018, has not explicitly adopted the position of the OECD guidelines with regard to the possibility under certain circumstances of attributing losses to limited risk structures. However, I pointed out in the slide that you see here, the Italian case law presents several judgments, actually reached a decision in which it has been recognized that also loss-making companies could be included in the final set of comparables used to test a limited risk entity. You see here, I write down the decisions of the Second Instance Court of Milan, where the judges rule that in cases of crisis, the selection of loss-making comparable is appropriate. The reference, the case dealt with the crisis of 2008, and the court, the tax court, the Second Instance Tax Court, ruled that the selection of loss-making comparable is and could be appropriate during the recession periods, such as the crisis of 2008 and 2009. So indeed, such comparables are suitable, according to the judges, are suitable for reflecting the existing market crisis conditions. And of course, this could be a very important case law, very important and decisions that could be used also for the crisis due to the COVID pandemic. So based on based on this case law and on this jurisprudence, we could let's say, we could support the idea that groups facing the negative impacts of current economic downturn may in principle be allowed to decrease the profitability of their limited risk retailer, and even, let's say, even attribute to these entities an amount, a proper amount of losses. Of course, this could be made and can be made also according to Italian domestic law, if the comparability analysis recommended by the OECD guidelines and also by Italian law has been made in the appropriate way. Comparability adjustments. It's clear, it goes without saying that COVID is producing a significant impact on third-party negotiations regarding prices and transactions conditions. And so it might be worthwhile to remake the 5 comparability factors identified by the OECD guidelines and also by the Italian tax law, by the Italian decree. And as far as, in particular, the first step, the first factor, namely the contractual terms of the transaction, one should pay attention to the possible presence in the contract of a force majeure clause. So we should pay attention if the contract itself contain a force of majeure clause. But not only we should check the contract, but then we should also check if the relevant governing law contain a notion, the notion of the force majeure, and now in a way is construed this force majeure concept in the domestic law, of the country. Indeed, national laws and practice may treat the force majeure in a different way and define differently the terminology and the notion of the force majeure. As far as Italy is concerned, under Italian civil law, there is no legal definition of force majeure that in a way expressly includes a sort of reference to pandemics. However, according to Italian case law, and here I put several Supreme Court decisions, according to Italian case law, force majeure is identified as an extraordinary and unpredictable impediment to carry out a certain action. And again, according to the jurisprudence of the Italian Supreme Court, provision of the administrative or legislative authority may constitute a force majeure event. So the suspension of non-essential activities indeed could integrate under Italian domestic law the notion of force majeure. Again, we should check then if no special legislation has been enacted to provide remedies to the pandemic event, which may in a way override the agreed contractual terms. And here I put the legislative decree of number 6 of last year, which in a way take away the possible debtor liability pursuant to Article 1218 and 1223 of the Italian civil code. So anyhow, the analysis of the contracts and of the governing law should in any case consider whether and how third parties could have actually relied upon such provisions. So we should in any case check if let's say a third party could in a way consider such an option as a realistic available option in order to in a way take into account also the force majeure the force majeure clause. Advanced pricing agreements and COVID. We know that the guidance on the transfer pricing implication of the COVID-19 pandemic also touch upon the implications, the impact that such a crisis could have on APA already concluded, or they are negotiated between the parties. And the OECD guidance encouraged, in a way, the taxpayers to adopt a collaborative and transparent approach by raising issues that might be relevant for the advanced pricing price agreements. The Italian program, the Italian unilateral APA program, in principle and usually provides for the amendments, Article 31 ter, provides for the amendment usually when the factual and legal circumstances of the agreements change, or if unforeseen or unforeseeable circumstances and changes to the initial circumstances occur that are likely to impact and affect the validity of the agreement. In this case, therefore, the Italian tax authority or the taxpayer, either the Italian tax authority or the taxpayer, may request a revision of the agreement in order, in a way, to update the comparability analysis. More frequently, actually, from a practical point of view, what we can see is that the Italian unilateral advance price agreements contain usually critical assumption according to which the agreement is valid under the comparable selected is valid if no changes occur in the functional and risk profile of the tested party, or if no significant changes occur in the economic circumstances of the relevant market of the comparable, which so usually these assumptions are always specified and expressed into the Italian advanced price agreement. So since, of course, critical assumptions have to be satisfied to be effective in order for the agreement to be effective, in the case the assumptions are not satisfied, then it is clear that the taxpayers must immediately inform the Italian tax authority within a time limit to update the Italian tax authority of the changes that occurred. Indeed, in the case of in the absence of this notice, taxpayers may, of course, face the risk of breaking the agreements and terminating again the advanced pricing agreements. Also, in this respect, the Italian tax authority have not yet issued any specific guidelines on the impact of COVID on the unilateral advanced price agreements procedures. And it is advisable, anyhow, to discuss with the Italian tax authority how to consider COVID on the existing agreements and on the future agreements. So this being said, and in conclusion, it is desirable that in the next months, the Italian tax authorities will issue specific and formal guidelines on the impact of COVID. So we must hope that formal guidelines will be delivered by the Italian tax administration, and hopefully the guidelines will be in line with the OECD December guidance. And we have to hope, we must hope that in this future, let's say, Italian circular letter, the main three issues that I've raised will be addressed. And again, the first one, the possibility to use loss-making companies as comparables, and again, clearance of the fact that also Italian limited risk entity could incur in a loss. Second, the possibility to operate downward adjustment directly in the Italian tax return, even in the case such adjustment, such downward adjustment have not been recorded, have not been booked in the balance sheet. And so in a way to relax the strict Italian TP provision in line with the flexible approach which has been endorsed, which has been advocated by the OECD. And third, and the third point I raised here, hopefully guidance also on the existing and future advanced price agreements. I am available, of course, for questions. And Gianni, I give you back the floor.
Thank you, Andrea. And you correctly, and I agree, highlighted the discrepancies that we have still from Italian tax perspective, and hopefully a circular will be more than welcomed. Maybe in the meantime, a solution as proposed by Raffaele would be even to create this dialogue between taxpayer and tax administration. But there is a question anyway partially for you, because I see at the end it was also for Yariv, who actually left for other commitment. So the question is, as pointed out in the presentation, the lockdown scenario resulted in the relevant losses incurred by the local entities or multinational groups. Italian Supreme Court has often affirmed that the determination of the arm's length price cannot result in a loss for the local Italian resident entity. And this would be in contrast to the general economic purpose of a profit-making company. This is a reputable presumption, but the possibility to provide contrary evidence is quite a narrow path, especially when transfer price issues are involved. This is the question for you, Andrea. There is also a question, which is the approach in other countries in this respect, for instance, in the USA. So, at least from Italian perspective, if you want to give an answer, of course, all the other panelists are feel free to intervene also for the other experience from other countries' perspective.
Yes, it's true that the Supreme Court has a really, let's say, narrow position, and in a way has required in the past that the low risk entity, the Italian low risk entity, should anyhow be in a profit position. But I read carefully the second instance court of Milan in the judgments I pointed out in the slide, and I think they might be helpful, very helpful. Of course, the crisis was the 2008 crisis, much different from the actual crisis. Also, the OECD states that they are not similar, but still some principle states that the judge state in such judgment may be helpful also to overcome, and also in a way to deal with the pandemic, and with the possibility to impute also to Italian low risk entity part of a loss.
Yeah. Okay. Thank you, Andrea. And we go ahead with Massimo Di Cesare, the head of tax from Richmond. Please, Massimo.
So thank you. I'm just trying to share. Let me see if it works. It's a little bit slow, but it should come. Voila. So here I would like to give a little bit of a view from, let's say, from the practical cases that we face. And because, let's say, the understanding of the company context, what is really specific and how, let's say, the company is performing is something that is a condition to understand the transfer pricing approach in COVID time. There are a series of interdependent factors which I listed, and really comes from what we experience in life, in the daily life of, let's say, of the tax matters in a group. For sure, everything starts from the tax strategy. It can look like a philosophical concept, but it's not. The way how the board defines its risk appetite towards the tax risk in general, and I mean all the other risk, is the criteria according to which the transfer pricing policy are set, and the way how, let's say, the strategy is deployed over long terms, over short term, more opportunistic, or rather having, let's say, something that is sustainable on the long term. This is very critical. In a group like ours, we are in luxury. We have maisons that have been there for 300-400 years. And of course, the criteria is to avoid any financial or reputational issue that could damage it. This is where, let's say, then this long-term horizon translates into a prudent approach and a low risk appetite in the transfer pricing matters, like all tax matters. Of course, this is also linked to the approach towards job retention. A company may be more, let's say, adaptive to certain circumstances, downturns in economy, and make recourse to certain measures, or even to firing people. So this drives a little bit the way also on how the company intends to protect or not the job basis. Then other points that have been discussed also by the other panelists, more technical, who really takes the decisions when in COVID times. This is a factor. If a company decides to, let's say, still maintain the jobs, and linked to the point above, to sustain the activities of the affiliate, of course, and this is done from the center here, already gives an indication on how to treat it, because eventually, of course, we face two tax authorities usually in this situation, and with very diverging views and objectives. And this we have seen in practical cases where really diverging views. Another aspect, and I will briefly mention this also later, is the consistency, and also, as Gianni, you mentioned at the beginning, of the consistency over time in the transfer pricing configuration, the configuration of the functional and risk profile between the principal and affiliates over time. This is a critical factor, because a possible change today because of COVID may also give a hint to tax authorities to still go to touch the open years, those not barred by the statute of limitation. And this is something that even the OECD, there was recently last week an official of the OECD that said, well, yes, this remains as a possibility. So it requires care. Then the other aspect, which is a key risk management factor in a tax strategy, is the relation and the approach towards tax authorities. Whether there is a bilateral APA or unilateral rulings, or any way an open and transparent table of discussion, this can change the approach, because it may allow companies and the poor tax managers to go and discuss with the authorities certain approach. This unfortunately is not possible everywhere. Not all authorities have the same collaborative approach towards taxpayer. And the last point I wanted to mention is the overall group result. Even Giacomo hinted at this before. I'm talking about the, I think, Parmigiano. There are, let's say, the overall result, especially for listed companies that publish their result, may have a psychological effect, because in one case you say, okay, you suffer the losses there, but you have made huge profit in other jurisdiction, and maybe the company is making an overall profit. Of course, would be seen by a local jurisdiction as a very opportunistic approach and short term. And this is something that goes together hands in hands with the other aspects I was mentioning about reputation, about consistency over time. So any alternative transfer pricing approach and so also certain mechanism that can be deployed with some criteria, as Giacomo mentioned, must be tested in a 360 degrees with all these parameters that we're about, because this is a test of, let's say, of sustainability, or let's say, over time, and also reasonableness. Because we know that OECD guidelines are definitely not prescriptive. More or less, they are declarations of intent of what we see, because then taxpayer and tax authorities are very, very selective in interpret, especially tax authorities, if I may say. For example, when we talk about all the principles listed in the guidelines, we see that in theory we could accept loss-making comparable. Never seen one country say, yes, okay, we accept the loss-making. So usually they look at the profit-making. This will be very interesting in the post-COVID times, where the audit for the COVID times will happen. So it's clearly this COVID will be a source of tension, a source of misunderstanding. This is no doubt, and this is where the robustness of the thinking must be really tested well. And then making somehow a bridge to what Giacomo mentioned at the beginning, or even the OECD guidelines about the ASER risk, about the insurability or not. Just to link into this concept, one could arrive to the conclusion that, in fact, companies may make an effort and so buy a premium, which is the replenishment of a loss. Even, let's say, putting at break even, or let's say very small profit. And this is a kind of insurance policy. An insurance where you don't pay the premium, just make it on retention. And this allows to safeguard the past and the future. And of course, let's say then we can go into technical aspects. Trying to identify certain exceptional costs that occurred. And of course, this has to be done. It's part of any transfer pricing review that multinationals do, to try to isolate and verify what has to be borne locally and what has to be borne centrally. Eventually, again, it's as often happens in the tax world, is a case by case. So, and my view is that anyway, any solid methodology has to be tested with the criteria defined above. If the board doesn't have any, let's say, intention to run a risk, because the risk may have occurred in certain jurisdiction where for 2000 reasons you don't want to have a dispute, then of course this drives the immediate translation into practice of what can be a theoretical concept, and then this drives what to be done. This is, yes, what I wanted to say in practice, and trying to stay in my 10 minutes. Yeah,
yes, thank you. Thank you, Massimo, and thank you because you also highlighted these scrutiny risk for the past years, as I said, as reported by your slide. You said that the hazard cost can be rolled back retroactively in time. So this is the risk. It looks like overreaction today may bite tomorrow and somehow.
Yeah.
Thank you, thank you. Let's go ahead. Alexander Albrecht from Ferrero. Alexander?
Hello, good afternoon. Can you hear me?
Yeah, we hear you. You can.
Thank you. I'll share the...
Alexander.
Sorry?
You can share the slides by yourself.
Yeah.
Okay. Thank you.
Can you see the slide?
Yes, perfectly.
Thank you. Thank you, Gianni. Thank you to all the colleagues present. I would like to make just a few comments about what we discussed so far, also taking into account what the colleagues already highlighted. From, I would say, a fast mover consumer goods perspective, because Raffaele mentioned that COVID had an impact and there were losers, there were winners. We can say sectors like food, consumer are not losers, are not winners, are by definition stable markets. Therefore, what we discuss about the TNM in terms of profitability must be declined, not really in my personal view, in terms of strongly declining turnover, but more in increasing costs, which can for sure impact TNM, impact profitability, impact P&L, but in a slightly different way. That's the reason why I propose to discuss a bit about the allocation of the COVID-specific costs that were present during this 1 year, almost 1.5 years of pandemic. OECD discussed this point in a very, I would say, detailed way, considering that there was not a lot of time for OECD to elaborate a bit. The costs that were discussed by OECD are mainly non-recurring operating costs. We had some example, and we could indeed see that in practice. During the first month of pandemic, we all remembered those very bad months in which everything was missing, and that was the moment when centralized purchasing of many things, tangible things like protective equipment, or intangible like IT infrastructures, were very important in order to guarantee a smooth business continuity that in those months, again, was not really easy to guarantee, in particular for industrial companies which could not shift completely in remote working, but still had to go and to produce for the market. Such examples are here in the slide. I cut and paste from the OECD. Personal or protective equipments, IT infrastructure, the necessity to remake offices in order to implement and to improve social distancing, and other safety equipment, like also tests in offices or factories, like gloves, everything, but it costs really million euros, I think, for many of our companies during this period. And the negotiation, in particular, the central phase was really, in our view, really important, because we all remember there were no masks, there were nothing at the very first phase. And it was important to have central entities negotiating for the whole group. The problem is that it's not a problem, it's a principle. OECD set the principle, which is also based on arm's length, but also on common sense. You cannot leave all those costs in the central entities. It will indeed, they stated that it will be important to consider how this cost will be allocated between independent parties operating comparable circumstances. For example, if we have factories and we had a negotiation for protective equipment at central level, we cannot think about leaving everything at central level, because this would be against the accrual principle, a true and fair view of the profit and loss, and also tax authorities would not be very happy, in particular in the central office. The central office tax authorities would not be very happy about taking all those costs. And I make reference also to the discussion we had about the central keeping of losses. It depends on the tax authorities of the principal or of the headquarters. If those tax authorities are happy and are ready to accept a situation where there is a certain level of costs which are kept in the headquarters, or they want to see that those losses, those costs, are effectively moved to the other entities. What we can see is, for example, we discussed a lot about limited risk distributors, but we also have to think about manufacturers or same distributors. Those entities, if without the group, they would have purchased, they would have borne those costs on the market. There is no question. Therefore, it's not sustainable to keep all those costs in a central entities. In particular, for example, for manufacturers, they can be toll manufacturers, they can be contract manufacturers, but they have a certain level of risk, of production risk, that they have to keep. So I would tend to agree with the OECD position that all those, at least a part of those costs, must be reallocated to the companies that would have borne those costs in a standalone position. This is easy to say, but maybe a little bit difficult to implement. I would just try to make an example, which is for sure can be also seen as a real life example. If we have centrally purchased equipment bought by a central entity, bought by a central contractor, and in the hurry of 2020, it was not always possible to differentiate and say, okay, send one invoice to company A, one invoice to company B. It was done very quickly, and at a certain point in time, we arrived to the conclusion, we are now 2021, we need to reallocate those costs. But let's have an example. We bought masks, or we bought any central or any other similar cost, I don't know, tester, whatever can be purchased for the benefit of manufacturers. Those are goods. If now we want to reallocate those goods, how can we do it? Because we reallocate a bunch of costs which are substantially goods. And we all know that reallocating after 1 year, and this is the ex-post approach, reallocating costs after 1 year cannot be the easiest thing. Criterion to be adopted, drivers to be taken, markup. Shall we adapt a markup for the negotiation of central costs? Not easy. And a very not always, but very often neglected part of this kind of ex post adjustment is the VAT. VAT is not very much in mind of the discussions in terms of reallocation of profitability, but it can be a huge issue. Not really within the European Union, because we are still in a rather flexible environment. But if we have customs, can be tough, or if you have domestic VAT to be applied, if you want to reallocate the cost of equipments 1 year after, and you should have applied VAT on those costs, someone can tell you, okay, you are in delay in invoicing, and here are the penalties for late invoicing. I hope that this will be taken into account also in 1 year or two, when we will audit all these kind of situations. But for sure, it can be a tough discussion, because we also hope that in 1 or 2 or 3 years we will have forgotten at least this moment, and but we hope that also tax authorities will not forget that it was a moment of difficulty for companies. IT improvements, there was a huge amount of cost for IT improvements also, and IT is I would say a typical cost that is born at central level, because the negotiation, there are very few players in IT. It's much better to negotiate those costs at central level. For example, the IT infrastructure, all the remote working activity had to be refurbished very quickly or adapted very quickly. And also in this case, we can say million euros could have been spent on those items. Shall we relocate those costs, or shall we keep them in the central entities? And shall we consider, this is also a very interesting consideration OECD made, most of those improvements are not necessarily COVID related, because COVID was a trigger for many factors, but improving the IT infrastructure is not necessarily something that is like masks driven by emergency. It can be considered also an improvement for the future. So shall we consider those costs really COVID related, or can they be considered like a moment of improvement, but not necessarily COVID related? And also in this case, shall we apply a markup, or shall we not? If we stuck to the general principles, yes, there is a negotiation. At least the structure should be remunerated, but this could mean, and this is the same reasoning for the other costs for material and protective equipments, that will mean that you make your controlled entities even worse off than they were before. We were talking about loss of profitability. If we recharge more cost, this loss of profitability could be even worse. Considerations on the comparability of those costs. For sure, it's very important that we are able to carve those costs out if we are in a situation where we have to apply TNM, at least to consider that the profit levels are not impacted by those costs. For me, it's very important also another point, which is related to all the TP methodologies which are based on cost plus. For example, contract or toll manufacturers, if those costs enter in the computation for tolling fee or for contract manufacturing fees, this could be an issue, because you are inflating your cost base. And for example, if you have a principle recharging central cost to the toll manufacturer, those costs must come back. So at the end, you make a round trip of costs, and this could be a little bit misleading in the profitability analysis and in general to the profit and loss of the toll manufacturers. In case of contract manufacturers, if you are centrally, you are recharging all those extraordinary costs, you are increasing the cost base, but those costs, for example, must go to the market. So in theory, you should, the contract manufacturer should increase prices, but we are not sure that, in particular, in a market of commodities, that the end customers are ready to pay for those additional costs that have been recharged to contract manufacturer. So I think this is also an interesting point, because these central costs, which indeed, in theory, based also on OECD and on arm's length principle, should be recharged, could determine an effect that we don't want on prices and on to end customers, but also in intercompany situation. Last but not least point, we should find an accountancy consistency in order to improve comparability, and this is what will be also a challenge in the future, because many companies could have booked these COVID-related costs in different part of the profit and loss, for example, as a direct production cost or as other operative costs. And this could, when we, in 1 to 3 years, we will be back and we will check the comparables, this could not be easy to carve out. That was my last consideration. I hope that you have kept my 10 minutes. And
thank you, because you provide really interesting practical inputs that we need to take into account when we talk about also about the extraordinary cost. Thank you very much. We run to the other contribution from Francesco Birindelli, Head of Tax of OTB. Please, Francesco.
Thank you very much, Gianni. Let me share my presentation. I do not know if you can see it.
Yes, we do.
Okay, thank you very much for the floor, and I'm very grateful to be here. I must admit that all my co-panelists and speakers have given a very interesting view of what happened in this past month and the decision that had to be taken. In order to focus on the subject that we have decided to be treated by myself, which is the effective possibility to recover losses that have been accrued by limited risk distributors, I would like to step back for a second 1 year ago. Because all of us having to manage this situation were like stoned and convinced that we were facing an unpredictable moment, and many questions started to rise. First of all, something that now is given for granted, which is, can my limited risk distributor support part of the losses that would be generated by this COVID situation? And of course, this has been a discussion that was very intense and that animated all of us. Now it's given for granted, but it was not. After having seen and decided that, of course, there could have been a shift of losses to the limited risk distributor, even though the transfer pricing methodology implemented until the moment was TNMM, there was a second big question that was whether those losses how those losses had to be calculated, because of course the situation was not clear at all. And all this seemed to be very complex to me, and maybe the most complex task for a tax person and transfer pricing person in life. While today, 1 year after, it seems that this was quite easy, because there is a large consensus that says that there are losses at the local level, and there are a few ways to calculate it. Now we are actually struggling with several elements of uncertainty, which are country specifics, which are several factors that shall be taken into consideration, different ways to consider for the future. And I think that what we are facing in 2021 is even worse than what we were considering in 2020, because as it has been said, of course, the results of 2020 have been considered as a one-time event, while we have at least one time times two. My friend Giacomo, which I thank for the copyright, has put together a very effective case with the P&L of a limited risk distributor. And when I have a look at it, I can see several elements that retain my interest. Of course, first of all, the split in 3 periods. Then we have 1 year, but 3 periods that have been taken into consideration, which of course I share. If I go in the on my left, I can see the green side, which states that there is a profit of 4%, which is due, assuming a normal activity, to the performance of the local retailer. And already this is an assumption which is to some extent, of course, real and practicable in for some companies, but not for other which are not maybe in the luxury segment, because 4% is already quite a high remuneration for other retailers, for example, those that are in the premium market. And this is not only resulting from out of benchmarks, but also resulting out of practice with tax authorities when negotiating your own situation. Then 4% is already solid. We have a loss of 75 euros in this example, and of course, no debate. And then we have a profit of 0% in the last lockdown period, which maybe is already been factoring a contribution from the principal in order to support the poor performance of this period. Then there is already an overall contribution of the principal, and the exercise ends with a loss in terms of percentage of 10% combined over the year. If I take a simple example, which is actually a figure that has been given by Camera Nazionale della Moda, which says that average 28% loss in turnover in the fashion industry, this means that 10% is only a limited portion of the losses that have been generated by the sector. And this drives to 2 additional conclusions. First of all, the principal may suffer as well as the limited risk distributor, and 10% may not be the case in some realities. This was a necessary introduction to a point that actually to the exercise, in order to have my critical assumption on what is the predictable future of these limited risk distributors. Those limited risk distributors, of course, are taxpayers in countries that will be willing to have some taxable base in the future, in a foreseeable future. Then, first of all, let's go back to what the limited risk distributor is doing. What is the reality? We said that is a pure retail distributor. Of course, is monobrand. As of the organization of the M&E, of course, we assume that there is no e-commerce sales. Then for the period of closure of lockdown, there was no business at all. As said, monobrand stores. Then of course, risk is not diversified. And as of 2019 and 20, the methodology that was retained in order to set the profitability of the company, of the taxpayer, was TNMM. As said, I'm not focusing top luxury brands which may show very high or relatively high returns, but I'm, for example, having consideration to premium brands which have a different positioning and may very well be in the region of 2–3% returns, net returns on a yearly basis. Now COVID's arrive. What we were saying, we are in March, and there is the bomb that explodes. First of all, it explodes in China, and it seems very far because usually things stay in Asia, but it is not the case. It migrated very fastly everywhere in the world, and our limited risk distributors, because of course we have a geography that is widely diversified. I'm speaking about the sector which is fashion and luxury, which, even though is not one of the biggest in terms of turnover worldwide, has a very wide and invasive presence in almost all Western and Asian countries. Then we have store closures everywhere, and those store closures are driven by government decisions. Then it's not the entrepreneur that says, oh, okay, I step down because of the situation. It is government that says I cannot go and do business anymore. The business I'm referring to lives on foreign travelers. I mean, everyone knows that a store in Paris sells more to foreigners than to French people, but the proportion is like 80% to foreigners compared to 20. Then my clientele really ceased to exist. And even if at a certain point in time in 2020 around March, May, almost every country started to reopen, there was a limitation of traffic and driven by lockdowns, curfews, and generally speaking by the limitation of movement of people that affected incredibly our business. Then of course, we already gave, my colleagues already gave the answer, but the first question was, can we assess that an LRD can escape losses in this scenario? Can we accept that the foreign tax authority would ask to compensate our foreign subsidiary with transfer price adjustment? Of course, answer is, in my view, no, because as we said, there is much more than a relationship between the principal and the limited risk distributor. But and the second big question is who shall bear this consequence? Then who shall bear these losses? And we said that at least limited risk distributor shall bear it, because the local government was at the real base of such a closure. But of course, there are some reflection in the principal's economy. I tried to go down to the nature of the cost of the pandemic, and I think that there are a few very interesting interesting examples, because of course we are almost all thinking about Western examples like Europe, where all the countries has been acting in a different way, but very uniform in terms of consequences, because the number of closure days were the same, and let's say the limitations were very similar to another. But let's think about China, where of course there have been very strong lockdown, but a booming economy with no more lockdown. Let's think about Japan, with at any time the government has imposed closures, and the sector, the fashion and luxury sector in Japan was very resilient, and actually there's been an opportunity for some brands. Let's think about Korea, no lockdown at all. Then of course it's very difficult to say who the cost of pandemic shall be imposed on, but my conclusion would be that it shall fall on the government that has actually determined the success or unsuccess of its own business model. And China, I think, is a great example, because they were the first to be affected, they were the first to be closed, and it ended up that they were first to reopen and to do business and to have high net profits at the end of 2020. Then a second a second comment really goes to the business model of our limited use distributor. Is it possible for the limited use distributor to adapt this business model in a COVID situation? My answer is for sure no, because we are asking to our retailer to do just retail. Then once that you cut the only way to generate incomes, of course, there would be no way to recover. While this is not the case of the principal, that in a multinational enterprise, of course, has several functions that can adapt and react. And this is something that, of course, cannot be forgotten. Then, of course, the end is that my first conclusion would be that the governments that have been not able to manage in an effective manner, regardless of the fact that they could be guilty or not, would have to assume these losses. And of course, the big point would be in 5 years, 6 years to defend this position against tax authorities. Now we go back to the example and to the 10% average loss in 2020 that was deriving from the mixture of the three periods. Then, of course, we have seen that those costs are deriving only from operating costs, because there would be no loss on stock during the period attributable to the local retailer. And if we take the 10%, that was the example that Giacomo did, and we divided by 4%, which was the expected return in normal, normal exercise, this would bring us to a 2.5 years recovery period, which is, of course, it sounds. I think it is a very good period to recover. The point is that, in my view, reality is not that we have a 10% loss where we are much above, because of the example that I gave, the 28% drop on sales of the overall sector. And presumably, at least for some businesses, 4% is too optimistic. As a result, the duration of the recovery period may be much longer, and this may not be acceptable to some tax authorities. Then I really think that we shall stick for a second to reality, and reality is, for example, that a benchmark of European countries of retailers shows a profitability of 1.5 up to 3%, which already brings us in a much longer period than 2.5. And of course, I do agree with Giacomo when he says that we should presumably recover our losses in a period of 3 to 5 years. My point is that difficult to do it with an application of TNMM because of these numbers. Because, of course, if we start modifying the 4% and bringing it to 2%, which in my view is the normal profitability of a retailer, this would go already to 5%. And we have not been considering that 2021 is another extraordinary year, because we are moving from ordinary to extraordinary lockdown periods, which means that if I add up 2 times 2020 and 2021, the overall losses will never be recoverable in 5 years. And of course, there are other consequences which have not been factored as of now in our discussions, of course, because the only reaction of a retailer to such a circumstance is to reduce unprofitable, unperforming point of sales. What does it mean? That there will be lesser volumes, and even though you apply TNMM, there will be lesser EBIT in absolute numbers, which brings us our 2% even to a lesser number compared to the loss. Then let's say that my wizard analysis is that we are no more in a situation, in a condition that would allow us to use organic TNMM, then an organic application TNMM, in order to recover the losses. And I must confess that my position is very near to the one of Yarif, that arm's length concept is now back in the past and is dead. We are trying to elaborate some purely technical solutions in order to find a possibility to have our limited risk companies back to profit. This very colorful slide is explaining what I try to describe in words. Hopefully colors will help me. As said, that 2020, it was the shock moment where all of us had to understand what was happening. But 2021 is exactly the same thing, because this is what we are living, and our companies are even weaker than they were before, because they have less exposure in terms of retail, of number of point of sales. And so there is an incredible polarization of purchasers, meaning that we know that in an economy which is suffering, there are losers and winners, and not all retailers are winners. Actually, a big number of retailers is losing, is a loser. We know that there has been a great switch in consumption habits, which means that retailers have no more the role that they had before because of the internet, of the e-commerce. And additional thing, we will have to build up our own benchmarks with years, that is 2020, which are already affected by an incredible crisis. That makes the exercise very, very difficult. And 2022, hopefully, everything will be done. We will, let's say, be back to normal, and our volumes and our turnover on which we will apply the considerations for the TNMM will be even lower. Then again, I think that the profit line is not near in the future if we just work on, let's say, the old-fashioned TNMM approach.
Francesco, sorry, since we are much beyond the timing, sorry if I put pressure.
No worries.
On timing. We are almost 20 minutes. So if you can get to the conclusion.
I'll try to speed up. Then this ends into the consideration that we will not be able to integrate the TNMM method by its own, but we would need to add considerations to TNMM in order to find a solution and an acceptable duration of the period of losses in foreign countries than in countries of LRD. Then first consideration is, will TNMM be able to be an acceptable method to compensate retailers? I presumably think that this will not be the case for a lot of businesses, and we will need, then of course I'm trying to skip, we will need to be a little bit creative. For example, we can benchmark the use of actually the outcome of TNMM with profit split. I heard that Raffaele was not in agreement, but to some extent the flexibility of the principle to adapt to new business concept, business environment may bring the principle in a position to be more profitable than before, because it hasn't stopped. Another approach could be can be to consider and to factor the new role of the principle for some areas like the e-commerce, in order to see if we can allocate to the retailer new elements of value creation in the chain. Because, for example, we can determine that the M&E, instead of putting a billboard will just keep a window with its own brand, and this would be a marketing cost. Then we are now page 4. Following the former concept, of course, I think that some groups would need to consider shift of profits on other criteria that would allow the limited risk distributor to be compensated, such as extra profit from e-commerce or marketing subsidies, as I was saying. And finally, take into consideration the OECD approach or other approaches that are in foreign legislations, which relate to the concept of startup. And of course, concept of startup brings to the idea that we shall find a time limit. The conclusion is like the start. 2020 was seemed to be the most complex year, while it is 2021 seems to be the very complex year, because we have to factor this new reality, and 2023 and following, I think we would need to be very creative and possibly to adopt unprecedented solutions to support our the profitability of our retailers. Gianni, I tried to speed up as much as I could.
You have been great. Thank you very much. Thank you very
My
much,
pleasure.
of course, for the content itself, because you have been you have provided many inputs as well about e-commerce, as we discussed at the beginning, about also the recoverability of the losses. And this is yeah, just to to close the circle about the position we have discussed before. So we are 30 minutes, I guess, beyond the timing. So, but I want to give the floor for the conclusion to my colleague, to the co-director, to Professor Fazzini. Please,
Gianni, thank you so much. Well, it's a little bit late, so I don't want to take your time. It's 30 minutes past 7. So I'd like to thank you, our speakers and members of IBTC, that it's the first workshop that we organized, and I think that it was really interesting, really successful, thanks to the quality of our speakers. And it's a very long story. COVID is a very long story, and I think that is very difficult to summarize all the interesting aspects that have been discussed during our meeting. So I don't want to try to make a synthesis of what has been talked about, because I think it's very complicated and we don't have enough time to do it. What I want to do again is to thank you again to all our speakers. And I want to remember that we have a next appointment, another webinar on April 28th on management fees. So we are going to discuss about management fees and the tough relation between firms and tax authorities. So I give you an appointment for next meeting. Thank you again to our speakers and to the people that had patience to wait until now. Thank you so much and see you next time. Bye.